Look no further than the 9-period exponential moving average when you're looking for a strategy that strikes that perfect balance between speed and reliability. Now, the 9 EMA, right? It's just a calculation, uses price data weighting to create a more responsive indicator. So unlike traditional simple moving averages, it just gives more weight to the recent prices. So it's going to be more sensitive to recent price changes. And this sensitivity is going to help you quickly identify short-term market trends and, of course, potential trading opportunities. So why is the 9 EMA specifically chosen? Well, the answer is in that balance between responsiveness and how reliable it can be. And generally, when prices cross above or below the 9 EMA line, it often signals a potential trend change. And this is going to make it easier for you to make faster trading decisions, especially in fast-moving markets where those quick reactions with an indicator, it's pretty important. Let's take a look at some common strategies that are used with the 9 EMA. And popular crossover strategies do offer you multiple ways to identify an entry and an exit point. And one really widely used approach is the 920 EMA strategy. And traders just look for a crossover between these two moving averages to show the trend direction. And I like this strategy because essentially what it is just a pullback and a reversal strategy. And you can trade it pretty objectively with some rules. You can also combine the 9 EMA with the 21 and the 55. And that gives you additional confirmation, although the stats out there are pretty mixed when you're using multiple moving averages. Now, I think the simplest way to use it is in this particular strategy, and it's the 9 EMA in a bull flag pattern. So the first step in this strategy, just identify the overall trend, right? So just look at the 9 EMA. If price is consistently above it, well, it's a prevailing uptrend. And that's going to be your first cue to prepare for a potential trading opportunity to the upside. And then we want to see a bull flag pattern. And this is just a classic continuation signal in an uptrend. Obviously, on the flip side, it's a bear flag. And the pattern is going to start with a strong upward price movement, right? We call it the flagpole, followed by a period of consolidation that can slope downward, can go sideways. We're just looking for a tighter consolidation, no momentum to the downside. And that forms the flag. And another thing is just make sure that flag does not retrace more than half of the flagpole, because that's a lot of selling. And all this setup does, it indicates a temporary pause in the uptrend before it potentially resumes. Now, your entry is pretty important. You can enter a long position when price breaks above the flag's upper trend line. And a breakout that's accompanied by slightly higher volume, that's even more significant because it does suggest strong buying pressure at that time, and it increases the likelihood of the trend continuing. But we want to see volume coming in after the break as well. And a more aggressive approach is looking for a simple range expansion with some higher volume. And managing risk, always important. Simple just to place a stop loss just below the lower trend line of the flag pattern. And it's pretty strategic because it does protect you from potential losses if the price unexpectedly breaks downward instead of continuing the uptrend. And we got to take profits somewhere. One way to do it, just measure the length of the first move up, the flagpole. Add this measurement to the breakout point to establish your target price. This is going to give you a clear profit goal to aim for. It's going to align with the continuation of the trend, but it's not going to be exact. Or simple enough, when you see a large range expansion in the opposite direction of your trade, you exit. Now, risk management, it's important to the success of any trading strategy. It doesn't matter what it is. Start by setting some clear stop loss orders because you got to limit those potential losses. And position sizing's also critical. You don't want to risk more than 1% to 2% of your account generally on a single trade. And you can even break down position sizing even further where you're going to take 25% of your capital, apply that to the instrument, and then you look to protect 1% to 2% on the downside. Now, look for a favorable risk reward of at least 1-to-1 and consider using a trailing stop depending on the movement of the market. Now, you're going to have a higher win rate when you're looking at 1-to-1 ratios. There's a better chance of it hitting 1-to-1. It's a lot better chance than waiting for 3 times your risk. Now, the 9 EMA strategy, right? I think it's a pretty decent tool for helping you understand reading the trends, making a good trading decision, and it's especially effective, as most strategies will be, when you combine it with risk management and a well-defined trading plan. So the 9 EMA is going to give you a quick signal in terms of trend direction. It's going to give you flexibility across various markets. Now, it's not a guarantee of success at all, right? Start with small positions. You want to practice it and just develop the confidence to use this strategy.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.